All right, everybody. So right now, I'm going to show you ICT concepts mixed in with my supply and demand strategy. All right. For some people who know, I trade supply and demand, right? And for some people who don't know, I also give a little bit of the ICT concepts along mixed in with that. Okay. So I'm going to show you how I tend to trade this strategy and implement it with my supply and demand. Okay. So some of you guys may not know, but gold is a beast. It's a volatile pair. You don't want to just trade it blindly. Okay. It's not like most pairs where they just move slow, respect structure really well. Like you need to understand that this pair is very volatile. Okay. So I don't recommend you trading this pair if it is going to bother with your trading plan. And if this is something that you don't like really trading just due to the volatility, okay, I will practice it on demo first before we even get to it. But this is something I do like to share with you, okay? So if you guys know, I like the sessions, London, New York, and Asian, okay? So when it comes to gold, I love to trade ICT concepts. And here's the reason why. It gives me more of a clear perspective and a clear direction on where gold is going. However, we all know that gold right now, we're in replay mode, okay? And then, we are also right now currently New York session. But I'm done trading for the day. So we all know that gold has flown up, right? Fed's cut rates. And so this is causing gold to just fly, right? Now, anytime you see a big movement like that, you do expect like some type of pullback to like these zones just for the gap. But for the time being, that's not going to happen because gold is just right now on its bull run. Okay. So what you want to look at is when it comes to liquidity zones, okay? You want to look at London's high or London's low, especially for New York. Now, some people might look for what they call a kill zone. You might look for a New York kill zone, but I'm not really into all that right now. Why? Because I know that a lot of times gold likes to take out certain previous sessions high or low, okay? So this is what you call sell side liquidity. Okay, so this is where uh people who have bought are buying, of course, and of course it's people where they start selling, but then the market would continue on in this bullish sentiment direction. Okay, so what I'm usually waiting for it on gold, I'm looking for like a takeout, right? And I'm not always waiting for a takeout. And when it doesn't take something out and just flies up, then I just go with my regular supply and demand strategy and just go with it, right? It is what it is. So it took out, let me go and take these EMAs off. It took out sell side liquidity, right? Now, most traders would just be selling this, right? Now, if you got in right here and you exited right here, then yeah, you would have got your 20 pips. But this is for people who are looking for a clear setup and people are looking to hold their trades a little bit more, all right? Especially on gold, because gold is going to give you that big killer RR, right? Gold tends to move 50 pips to 100 pips per day, sometimes even 150 to 200 pips per day, okay? So you really want to be patient with gold and you really want to know what you're doing when it comes to trading gold, all right? So sell side of liquidity is taken out. After sell side liquidity is taken out, this is my spin. This is where I put my spin on it, all right? I am waiting for this whole candle to either shift upwards or another candle to shift back upwards, all right? And I want it to break these high, all right? So we have this high broken, all right? So since this high is broken, we can now call this a breaker structure, all right? So to me, this is my high. It don't have to be your high. It can be this high or it can be this high, okay? Either high, it don't matter, all right? But for me, this was my high, all right? That was a breaker structure. You see either your gap right here or your demand zone with this order block right here. It can be right here. But this is not the area I was currently looking at, okay? All I know that we do have a breakup structure to the high. What I'm currently waiting on is a cleaner order block, okay? So most people would just look for gaps. I look for a clean order block, all right? And this is what I'm actually looking for, okay? So the market is continuing bullish, all right? Now, you guys see a low is formed, right? And then another high, another candle to break this high, okay? This is my order block I'm looking for, my order block. This is where my supply and demand strategy come in, mixed with the ICT concepts, okay? So I make it very simple for me. I don't use all these Fibonacci levels, all these indicators or indications of letting me know like, hey, you know, it's a bearish sentiment of an order block and gaps and all. I don't have to use all that. All I know is that it took out sell side liquidity. Okay, it came back up. It broke another high after a former lower high, and now this is telling me that an order block is being formed. Okay, so the reason why I did not take this whole setup is because I usually risk 10 pips, but on gold, it was requiring me 20 pips. But let me just go ahead and show you what would have happened if you would have risked 10 pips. All right, so this is your fair value gap mixed with your order block, all right, or demand zone, you can call it, all right. For me, it will be demand zone. Okay. And so the market proceeds upwards. Now, some of you guys are probably like, oh, well, Jonah, why don't you get in? You could have got in 15-minute candle, you know, or 5-minute candle, put your stop loss below here. No, you always, especially on gold, want to wait for some type of pullback or retest, okay? Gold is not a pair that you just take lightly. So what we get? We got a retest, right? Now, either two things you can do. You can wait for the market to come back up and break this high, and then you enter, and then you put your stop loss below here, or you risk it for the biscuit, and you just go ahead and put a long after the rejection. You see a candle rejection, which is right here, and put your stop loss mainly under here, okay? This, and the reason why we put our stop loss under here, because this is the order blocks low, okay? So you can stretch this over here if you want to, and simply aim for either this high or wherever you want. So because the market tended to go extra, anytime you see this on gold, especially when it gets right here and it keeps going up, just go ahead and put at 100 pips. So from 2036 to 4046, I'm pretty sure gold went that high. Let's see. Yep. And your take profit would have been hit there. So that was easy enough said for gold. And this is just telling you that you don't always have to just trade all the crazy, trading, perspectives, or have everything set in stone on understanding what ICT is. Just know that you can have a little bit of ICT concepts and implement it with whatever strategy you have and let that go. Now, where was my mistake? My mistake was I didn't put a 20 pip stop loss. I was literally looking for a 10 pip stop loss, and if I did, I would have been taken out. So instead, I cut my losses short, because when I entered, I saw this bad boy coming down, and my stop loss was right down here, and I said, you know what, let me just cut my losses, not realizing that my stop loss really should have been at this line, all right? For the simple fact that the order block finishes right here at this low. So that's just one example, and then the last example was a GU, okay? All right, so GPP USD was the demand zone. All right, GPP USD was a demand zone. A gap was filled here, and I'm not really about to, I'm not about to really go into deep detail about this, but there was a big old gap right here that was formed, right? Then it broke its high right here. Then it formed a demand zone, okay? And what happened is GU flew up, came back down, but never retested that demand zone and just kept pushing higher, okay? Which was a 44 pip. Now, some people might put their gap right here, which is totally fine because this is the gap. But for me, the demand zone was clearly for me right here, because I am the type of person where I want my order blocks to touch. Okay, so you could have gotten this gap right here, put your stop loss into here, which would have been a 17 pip stop loss, or gotten your gap right here and put your stop loss down here, which would have also been a 20 pip stop loss for a 50 pip run. So guys, that's the only difference between my particular supply and demand. My supply and demand setups, I like to see the order blocks touch. I want them to touch, right? I don't like just taking just a gap. right? Now, I might get used to doing that just because I'm seeing it more often. I have to see it more often, but usually I like my order blocks to be touched. Okay, and one of those clear examples, like for example, I think GJ over here, like for example, like here. Let's see here. Yeah, GJ was touched. Okay. So as long as anywhere from here is touching to here, this is where I like to enter. Okay. And if I enter, at least my stop loss, especially if it came down here, will only be 5 pip stop loss, but it went for a 40 pip run. So it just lets you know that you can use these ICT concepts along with supply and demand. And that's just all I have to show you for today, guys. The market is not necessarily in my favor. It's not giving me the run I wanted to give. And so I'm just going to leave the markets alone and just call it a day. So you guys have a wonderful December. I might post more videos. I don't know. It just really all depends. Each December is just very weird, and I don't like how things are just moving. It's just all over the place. It is giving some good setups and a lot of good bull runs for the XXX USD pairs. But guys, if you think about it, December is not probably the best time to start trading. So as far as just going all out. So all right, I hope this video was helpful, and I'll see you guys in the next video. Peace.